Good morning. This is Mayor Valensky with Driving Markets. Of course, the usual caveat, anything said in this piece is only an opinion. It's not investment advice, not financial advice. I know the viewers are beginning to learn this by heart, but any new viewers coming on board, it's just a media publication to give you a general wrap-up of financial markets. So let's get going. So on Friday, the markets were completely and utterly trashed because what happened was Jerome Powell and the Fed came out of the Jackson Hole Symposium in Wyoming. That's a meeting of bankers, economists, and federal bankers to give some sort of guidance or understanding what's likely to happen to the economy and financial markets over the next 12 months. And he came out with a warning that inflation is going to stay high, interest rates are going to stay high, and they're going to get as aggressive on inflation as they have been in the past. And that sent shivers down the back of investors and traders. And I've been saying this already for a while. Effectively, what you've got is you've got a bear rally. You've got markets that have risen, but the overall market is a bear market with the trend going down. And you've got to look at the Dow. The Dow closed more than 1,000 points down on Friday. That is one of the biggest falls in the last few years, and that is because there is serious fear that they're going into recession or the interest rates will go higher. So to be clear, I'm calling interest rates much higher than they are at the moment. I know by year end they're going to be maybe around about the 3.5–4% level, but next year we're going to be talking about 6, 7, 8% interest rates with inflation running at 18%. Why is that? Because the undercurrent, the underlying, the fundamentals of inflation have not gone away. You've got supply chain, you've got huge demand, you've got the macro and geopolitical situation in Russia with Ukraine, and that war could expand even further. There's huge demands on oil, there's significant demands on production, on goods. Shipping is being stuck around the world, and overall, all of that is adding to the big furnace cauldron of inflation that's causing a major problem, and central banks are well behind the curve. They need to start being a lot more aggressive on raising interest rates. In fact, the ECB, which is the European Central Bank, is likely to raise interest rates in September meeting by 100 basis points. That's a full 1%. Now you've got natural gas prices at an all-time high, and that's going to be fed through to the economy and to the consumer, where they're going to see a big jump in their gas, electricity, and the other energy prices, and that's going to take more money out of the household budget and could dampen down consumer demand. It could, however, because we have full employment, then that employment is effectively a balance against a recession. So there's a two-way flow going on here between recession and between growth. But what we're likely to have is a downturn overall in the economies. America came out with a negative GDP last month, and it came out just now last week with another negative GDP. Germany came out with a GDP that was negative, but the consumer confidence within Germany had compensated and was better than expected. So going forward, what you're likely to have is higher interest rates, higher inflation, and therefore the consumer will be likely tightening their belts as the year goes on. Looking at Bitcoin's fallen big time down below 21,000. We were calling it below 21,000 for a while, and I'm going to call it even further. I'm going to call Bitcoin down to around about 15,000 for those traders and those investors who traded. As regards precious metals, gold, silver, platinum, then interesting one, because I do like gold and I'd like to see gold back above 1800, and you could see an opportunity to buy it around about the 1700, 1720 level to go long of gold. Just be aware of that. Also, what you've got is looking at the Dow and the indices themselves are very high and like to come back. The Nasdaq and all of the startups and the high risk assets are likely to fall further. So I'm a big seller of the Nasdaq and big seller of any high risk assets, because any type of inflation indication, that's going to send those asset classes south. Also, the 10-year treasury is above 3% again, and therefore that's having a big impact on borrowing around the world. This is Mayor Valensky with Driving Markets. Have a good day.